You're not going to believe what just happened in the 1970s, and you're definitely not going to believe how it connects to what's unfolding in silver right now. Because back then, two brothers almost broke the entire financial system. They cornered 1/3 of the world's private silver supply, and in 1 year, silver exploded from $6 to 49. That's an 800% move. Then the government stepped in, changed the rules overnight, and silver crashed 78% in just 3 months, from $50 to $10. And if you're holding silver today or thinking about buying silver, you need to understand why that story matters right now. Because history doesn't always repeat, but it rhymes. And the rhyme is getting louder. Now, before we go any deeper, quick favor, if you're getting value from this breakdown, hit subscribe right now. We're pushing hard to grow this channel, and your click actually matters more than you think. All right, let's get into exactly what happened in 1980, why the current situation is both similar and dangerously different, and what you need to watch for if you want to survive what comes next. Here's the setup. The 1970s was a crazy period. Inflation was running very hard in the US. We're talking double digits. The US had huge fiscal deficits. They were hemorrhaging money on defense expenditure. Vietnam War, Cold War with the Soviets, a lot of chaos, a lot of uncertainty. And in that environment, investors were fleeing the devaluing dollar. They wanted safety. They wanted real assets. And that's when two fellows, the Hunt brothers, saw an opportunity. Now, watch this carefully. The Hunt brothers started to accumulate silver in a very big way, and they realized something that most people didn't see. Silver was extremely underpriced as a commodity versus the financial products and the money supply that was available. Silver had been left behind, so they started cornering the market, and they almost accumulated 1/3 of the world's private silver supply, approximately 100 million ounces, physical silver and futures contracts held on the exchange. They were basically running a massive leverage bet that made them the world's biggest silver holders and the most powerful market participants. And here's where it gets wild. When one entity looks like they're going to destabilize the entire ecosystem, when it looks like the exchanges could break down, when it looks like the exchanges could default because there are no suppliers for that kind of buying demand, the system reacts. And silver, in that 1 year, went from $6 in January 1979 to $49 by January 17th, 1980. 1 year, 800% rise. That's not a rally. That's a parabolic explosion. That's the kind of move that changes lives and destroys systems. Now here's the twist. What did the administration do? What did the Fed and the regulators do when they saw this happening? They decided to break the back of the Hunt brothers. And this is very common. Whenever the government sees that somebody is getting very powerful and they can control the markets, they will come and break their back. They are always looking to make examples of anything which is exceptional and to restore normalcy in those markets. You've seen many examples of this. Short selling gets banned when markets are hurtling down. Futures get banned when prices get too wild. So what did they do? They increased the margins by several hundred folds. These leverage bets, which were there on the COMEX, became unsustainable because the Hunt brothers could not put up that kind of overnight margin. And that forced liquidations. Now, let me be crystal clear. This is the easiest way for exchanges and regulators to break the back of a big bull or a big bear. Increase margins, demand more money, and once the money doesn't come, close the positions, force liquidation. And that's exactly what happened. That caused a complete panic sell-off. The Hunt brothers lost significant amounts of money starting from the very beginning of 1980, and then strict leverage limits were put in place. And a few days later, liquidation-only trading was announced. Now watch the irony of this. An exchange is formed for a fair buying and selling opportunity for buyers and sellers. But if prices go up, they ban new buyers. And if prices start to fall, they ban new selling. Silver fell 25% in one single day because of this action. One day, 25%. That's not a market, that's a slaughter. And there's more. The Fed chair at that time, Paul Volcker, was given the task to rein in the inflation, which was running very hard. 18%, 19% type of inflation in the US. So what did he do? He raised interest rates to 20%. Can you imagine? US rates, which were 3%, 4% in the mid-1970s, rising to 20% by 1980. Essentially, all liquidity rushed toward fixed income assets. When you can get 20% in fixed income backed by the government, who's going to buy anything else? So that kind of situation was created. And of course, big headlines about anti-inflation measures were everywhere. And then the music stopped. The Hunts lost a $100 million margin call, the markets plunged, and silver plunged over 30% in one day again on March 27th, down to $10. Just imagine, being at $50 on January 1st to almost $10 by March. That kind of price destruction happened in 3 weeks. 3 weeks. Gold was also in sympathy, going up and then collapsing. Gold went from about $250 in to almost $800 and back to $500 by this time as well. So the complete picture from January to March, silver lost 78%. Gold lost 45%. That was the biggest crash in precious metals ever recorded. And the lesson is simple. Liquidity, when it goes away, disappears overnight. The strongest fundamental thesis can be defeated by regulatory intervention. That's not theory, that's history. Now here's where it gets interesting for you today. When we compare the current situation is very different. It does not have anybody cornering the market, at least not anyone known in the market. Once an elephant in the room is identified, the system will try to bring it down. That's my belief. But right now, there is no elephant in the room that has been identified. It is a general trend which has caused these prices to go up. The confidence in the fiat currency is crashing, and the US president is helping this lack of confidence in globalization in a big way. The fear trade is on. Secondly, inflation is not running hard as of now. As in when it runs very hard, there will be actions taken to increase interest rates, even in the US. But we are not anywhere near that situation right now. And thirdly, if you see the longer view, silver has not made a new high since several decades. And it did very recently at $90. So it's not really overpriced from that point of view. Yes, in the short term, it is a bit overheated because we've gone up 140% or so. But you have to see it from a longer perspective. What is the commodity sector doing versus the financial sector? If you plot the S&P 500 to gold or silver, you'll find that ratio is still very high versus long-term averages. Now here's the part that should make you pause. The investor's takeaway from this is that liquidity, whenever it goes away, will disappear overnight. The strongest fundamental thesis can be defeated by regulatory intervention. So while we can always say that this time looks different, if there is regulatory intervention, anything can collapse tomorrow. So you have to make sure that you are not overly exposed or leveraged in any such situation, whether it is gold or silver or any other commodity. And you have to watch out for these signs. Is inflation rising? Are interest rates going to go up? Are we at a situation where exchange or regulatory action can happen because when the rules of the game change, the cost of carry hits very high? These are the ripe situations where even the deepest pockets will get liquidated. Now here's a cliffhanger you need to take seriously. The scariest part of the 1980 crash wasn't the price move, it was the speed. 3 weeks. 3 weeks to go from euphoria to devastation. And the people who got caught were the ones who believed it could never happen. They believed the fundamentals were too strong. They believed the trend was unstoppable. And then the rules changed overnight. Margins got raised, liquidation-only trading got announced, and they had no way out. So let me ask you a question, and I want you to answer it honestly. If the exchanges raised margins tomorrow, if they announced liquidation-only trading, if the government decided that silver was a systemic risk and needed to be controlled, are you positioned to survive that? Or are you leveraged to the point where a rule change would wipe you out? Drop your answer in the comments because your reaction tells me whether you're managing risk or hoping for luck. Now, let's talk about what you should actually watch for. First, watch inflation. If inflation starts running hard, like double-digit hard, that's when the government will act. They will raise interest rates aggressively. And when rates rise that fast, liquidity drains out of everything. Second, watch regulatory signals. If you start hearing talk about market manipulation, if you start hearing talk about protecting consumers from speculation, that's code for we're about to change the rules. Third, watch leverage. If the cost of carry starts spiking, if margin requirements start rising, that's the system telling you the party's getting too crowded. Now here's another twist. The current move in silver is different in one critical way. Back in 1980, it was two guys, two brothers, easy target, easy to identify, easy to blame, easy to break. Today, it's a general trend. It's fear, it's currency debasement, it's global uncertainty. It's harder to point at one entity and say, that's the problem. And that makes this moment both safer and more dangerous at the same time. Safer because there's no obvious target for regulatory action. More dangerous because if the move gets too big, if silver goes parabolic again, the government doesn't need a villain to justify intervention. They just need a crisis. And they can create a crisis narrative overnight if they want to. Now, let me give you a framework for action. You don't need to sell everything. You don't need to panic, but you do need to be smart. First, don't use leverage. If you're in silver, own it outright. Don't borrow to buy it. Don't trade it on margin, because margin is what killed the Hunt brothers. Second, have an exit plan. Know at what price you'll trim. Know at what signal you'll step aside. Don't wait for certainty because certainty arrives after the crash. Third, diversify. Don't put your entire portfolio into one commodity. Even if you love silver, even if you believe in the thesis, concentration is risk. Now, here's what I'm watching next. I'm watching to see if silver can hold above key support levels during pullbacks. I'm watching to see if inflation data starts accelerating. I'm watching to see if central banks start talking about tightening aggressively. I'm watching to see if regulatory language starts shifting towards speculation concerns. Because those are the early warning signs. Those are the signals that tell you the game is changing. And here's the part that most people don't emotionally prepare for. When a market crashes 78% in 3 months, it doesn't feel like a correction. It feels like the end of the world. It feels like everything you believed was a lie. And that's when people panic sell at the bottom. That's when people swear off the asset forever. And then 5 years later, when it's back up, they're too traumatized to touch it. So if you're in silver now, if you're riding this wave, understand what you're riding. You're riding one of the most volatile commodities on the planet. You're riding an asset that can make you rich and wipe you out in the same year. And the only way to survive it is with discipline, with risk management, and with the emotional strength to step aside when the music stops. Now, let me tell you what my gut says. My gut says we're in the middle innings of a commodity supercycle. My gut says inflation fears are real. My gut says currency debasement is real. My gut says the long-term trend for precious metals is up. But my gut also says that doesn't mean straight up. It doesn't mean no corrections. It doesn't mean the government won't intervene if things get out of hand. So the smart play is not all in or all out. The smart play is strategic. Hold a core position, trim into strength, rebuild on weakness, and never ever use leverage in a market where the rules can change overnight, because the rules can change, and they will change if the system feels threatened. Now, here's a final cliffhanger. The Hunt brothers thought they had won. They thought they had cornered the market. They thought the fundamentals were so strong that nothing could stop them. And then the Fed raised rates to 20%, and the exchanges changed the rules, and in 3 weeks they lost everything. Don't be the Hunt brothers. Be the person who sees the signals, manages the risk, and lives to trade another day. If this breakdown gave you a new perspective, hit subscribe right now so you don't miss what happens next, and drop a comment. Tell me, are you holding silver? Are you worried about a crash? Or do you think this time is different? I want to hear from you. I'll see you in the next one. And just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.